This year. Joining me is Kathy Bostjancic. She's the chief U.S. economist at Oxford Economics. Kathy, it's good to have you. What's your counter argument for those who still think the Fed's only going to be able to raise 4 or 5 times this year?
Thank you, Kelly. Happy to be with you. I think you have to look at the inflation numbers, and they're running well above expectations, the Fed's expectations. And I think you have to listen to Chair Powell today. He was very unusually explicit in not only indicating he'd favor 25 basis point rate hike in March, and you really got the sense that maybe he would be inclined to do more, but because of the outbreak of war in Ukraine, that he needed to temper that a little bit because of the uncertainty.
Sure.
But beyond that, he said inflation's running too high. The labor market, as you were talking to Steve about, is extremely tight, and demand remains really strong. So even though we have high inflation, consumers been really resilient. So the Fed's got to resort to tamping down on demand.
I think it's really interesting that jumped out to you the way that it seized a lot of us at the time to hear him say it so explicitly, but also you're reading from that, which is that, this is a Fed official who maybe even wants to do more. Why? What's the urgency? What makes the situation need such a swift and prolonged response?
Well, they're quite a bit behind the inflation curve at this point. We're going to get consumer price data next week, and it very well could be, close to 8% or at 8%. We're seeing the commodity market, oil surge higher, and we still have core goods prices still with upward pressure because the supply chains are still not eradicated. And then you add in the service prices, which, not to leave those out, put upward pressure. So they want to move quickly. And the more they can move quickly now, the hope would be that they can extend the expansion and economic gains and not really have to slam on the brakes and kill off the expansion.
Right. We're hearing more talk about stagflation this week. But do you think we're anywhere close to having a stagnant economy?
Not yet. Growth is still really strong. I mean, we think economic growth, notwithstanding the higher energy prices, we could still get over 3% growth this year pretty easily. We're more worried about 2023. Growth slows, but ironically, then inflation should follow suit. So it's a timing issue. So we don't really see a stagflation environment. We see high inflation now, high growth, and then potentially slower growth and lower inflation in 2023.
Yeah, how much lower, though? And I'm glad you pointed out that we still have this strong demand impulse, that it's not just, hey, because of the Ukraine crisis, at least what we know so far, that we're all of a sudden going to have a negative quarter, a couple negative quarters of GDP. So even though you do see the economy slowing, why won't that bring inflation back down to the Fed's target?
It's moderating. We had over 5% growth last year. You are slowing, so they are tightening into a slowing trend, but growth still 3% is well above the potential growth rate in the U.S., which we think is about 1.8. So that all else equal still puts upward pressure right on inflation, even though it should ease, still going to remain pretty hot. And our concern is it could remain too sticky. So I think it's best for the Fed to move quickly now. But come 2023, and that's what the yield curve is sort of indicating, will the Fed overdo it? And will we see growth much slower? And potential is demand slows, supply comes online, inflation goes below 2%, ironically, in 2023.
Yeah, that would be quite a reversal from where we are now. I mean, the final question is for those who say, listen, it's always kind of a cost-benefit analysis. So why wouldn't the Fed err on the side of caution by taking it easy here and going slow?
Well, it's a good question. And I think they are going to move cautiously, but especially in light of the war. But, Chair Powell, I think rightfully so, opened the possibility that if inflation continues to run above expectation, that 50 basis point rate move at any given meeting is on the table. And I think that's right. They're far, below a neutral Fed funds rate, which we think is 2%. They're still close to zero at this point, so they have a long ways to go.
Still stimulating the economy. In other words, Kathy, great to have you here today. Thanks for your reaction and analysis. We appreciate it.